70% of people who win the lottery, they go bankrupt within 5 years, right? Whenever they are advertising any cash prize on TV, just divide it by 4.
Just a few weeks ago, he bought another mansion again, and his kind of total worth of in real estate is around, I think, $80 million. So that
these people don't have any financial education, and they don't know how to manage money, right?
Exactly.
And I don't think I have that problem.
So the goal for most private equity, this is another tricky part, is don't put your money in it.
And basically all the ChatGPT, Midjourney, they are all running on NVIDIA GPUs. So there is a scarcity. Even I heard the UK was going to spend £100 million to reserve some GPUs from NVIDIA.
Hey there, how are you doing today?
I'm doing well. How are you?
Yeah, I'm fine. So today we will be talking a little bit about, we'll dive in a little bit into the news, and then kind of see how we can take some, I would say some insight or some learning point from there. But it's going to be mainly about, money, investment, and things around those lines.
Sounds like a plan.
So, I mean, regarding the news, how up to date have you been? I mean, I saw recently, the story of this guy that I think his name is Edwin Castro, and he won, the largest kind of lottery in the US. I mean, you're based in the US. Are you familiar with this?
Yeah, I've heard about that story. I think he won about like $2 billion, right?
Yeah, that's a lot of money, man.
Yeah, that's a lot of money.
But I mean, as we all know, in all these countries, even if you win all that money, the tax money is gonna be there, and based on what I've read so far, I think out of the 2.1 billion, this guy managed to kind of take home only around like 600 million, and the tax man just took most of the money basically. But 600 million is still a lot of money, man.
Yeah. I actually, later on, when I heard about his story, right, the way the lottery system works in the US is that when you win, usually the money that, or the price that they are advertising is not the real price, basically. So when they say you're going to win 2 billion, for example, like his case, right, what they are saying is that the actual price, the actual cash price is 1 billion. The 2 billion is that if you decide to not take a lump sum, that means you don't want to take the whole cash price at once, they will pay you this cash over 30 years. So you get, they call it annuity or something like that.
Yeah,
and you'll get paid every month for 30 years. And because you are being paid over 30 years, that money will be invested in some bonds or some stock or something like that. And basically you end up making 2 billion over 30 years. But if you decide to go with the cash price, just divide whatever they are advertising on TV by 2, right?
Yeah.
So once you do that, you'll get like a 1 billion. And then when you are going to receive that 1 billion, so you can just factor in 50% tax, and basically you end up with about 500 million or 600 million, depending on the state you are in. So all in all, whenever they are advertising any cash prize on TV, just divide it by 4.
Yeah. I mean, that's I actually didn't know that. I know that you have to pay for the taxes, but I didn't know about the part where they can pay you in annuity.
Yeah, it's kind of false advertisement.
I mean, okay. I mean, on your side, let's say you, for example, if you were to kind of win that money, would you go lump sum or annuity?
I would definitely go lump sum, because,
really?
Yeah, like,
okay.
What are they going to do
ahead.
that I'm not prepared to do on my own, right?
Okay.
So here is a fun fact, right? We heard that from just doing my research, I've heard that like 70% of people who win the lottery, they go bankrupt within 5 years, right? And usually the reason why that happens is because these people don't have any financial education, and they don't know how to manage money, right?
Exactly.
And I don't think I have that problem. Yeah, because I've been able to kind of grow a fair amount of wealth over the past 10 years, right? So I don't think I'll have that issue. Let's say I win. I have 500 million right now, right? I win that $2 billion. What I'll do, I will probably take like 80% or even 90% of it and just put it in like the stock market, and or put buy like some dividend stock, right? Or some dividend mutual fund or something like that. And that alone, if is like the dividend is like, I don't know. So let's say 80% of 500 million, that should be
40.
let's say
That should be.
400 million, right?
Yep, yeah, that's 400 million. Yep.
Let's say I get paid like 5% of that every year in dividend. 5% of 400 million.
That's 20 million. Yeah.
20 million a year. That is more than enough for me and my family to live on.
I mean, in a way, I agree with you. What I would say is that really depends on the person, right? So there is, I would say, the lazy route. So the lazy way is to accept, the terms that they have regarding the annuity, and then you get your money every single kind of year. And the good thing about that is, if you are not financially educated, that will help you into kind of pacing your spending and kind of not going broke, basically. So that's the very, very good thing about that. And based on what we've seen in the life of people that want those type of money, is that the entourage plays a huge role. Your family, people will be asking you for money. People will be seeing you differently. You are a target. Everybody wants something from you. So at least with that, you are sure that you are not getting broke anytime soon. In 30 years, you will still be there and you'll still have your money. So that's the lazy route. That's what I would say. And then there is the smart one. So the smart one is what you are talking about, and you are like, guys, give me my money. I want to do my thing. I can handle it. I will go the smart route, but I will use a different kind of strategy comparing to yours. So what I would say is that for those type of money, there are like. So actually, there are a lot of people that kind of, not a lot of people, there are a few people, I would say the high net worth people that kind of have these money, and they kind of spend it in different ways. So what one kind of first thing they will do is to estimate how much they need to live. So let's say they need let's say 10 million to sustain their kind of lifestyle. So they will do a quick calculation. How much do I need to invest, let's say at 5% to get that 10 million? And they will take that money and just put it in, I don't know, a bond. That's very, very secure. That's going to be like 5 years old. They will just open a bank account at not like the street bank account. In the UK, we say high street companies or high street banking firm. And those are Barclays and etc. And those, they give you very, very low, savings rate. In the UK, for example, you can go to, I don't know, Skipton building, for example. They will give you 5% or 3% or 4%. So you will, target those kind of bank and put your money there. And then you will be getting, what you need to kind of sustain your lifestyle. So that's step one. You sustain your lifestyle. Step two, now they have to kind of be a little bit more risky, and they will invest. So those rich people, I would say they will put a little bit of their money into like hedge fund and those type of funds, but I would say most of their money will go toward like private equity and those type of things. And really, the goal there is to beat the market, beat the stock market, and that's the goal. And if you invest in private equity, your goal is to beat the stock market. So that's what they will go for, and I would say that's what I will definitely do in my case. So
yeah, I think I will do the same thing. I kind of didn't expand on all the things I would do if I won, right? But
okay.
I'll definitely do the same thing. It's not just like buying stocks. And in the US, I don't know if you heard this. Back in I think March or May, there was a bank that went bankrupt basically, and it was closed. It's called Silicon Valley Bank. And basically, what happened is that in the US, there is a law that for every bank where you put your money, you can't put more than a certain amount.
Oh yeah.
So there is a limit on the total amount of money that is insured by the bank. And here we call it FDIC. You can look it up. It's like federal something. But basically that amount is $250,000. So you can really put more than $250,000 in any bank account, even for a business, right? So the government does that so that, money can circulate in the economy. So definitely just putting your money in the bank with low interest rate, that is a no-no, right? Especially that much money. Because when Silicon Valley Bank went under, there was a talk at some point, a lot of startup in Silicon Valley had their money in that bank. And at a certain point, they didn't know if they were going to get that money back. So that's one thing to think of. Regardless, they were lucky enough, the government stepped in and everybody got their money back. But this is not something that is impossible. And later on, 2 other banks failed because of high interest rate environment that we are in the US. But this is something you need to think about. So definitely, even if you are not going to buy stock per se, you can buy like government treasury bonds. And those are even more tax favorable for you. So when you get paid that return, the taxmen won't tax you too much when you get that money. I started by saying that I would take 20% of my money and put it in one of those financial instruments, right? And the 20% that is left, I'll basically do the crazy spending that you're doing in the first year.
What do you mean by crazy spend? Do you do any crazy spend? Because this guy, Edwin Castro, he's only 31 years old, right?
Right.
And the second he got his money, I think he bought first a mansion. He bought then like a Japanese inspired mansion as well. And then recently, I think just a few weeks ago, he bought another mansion again. And his kind of total worth of mansion, let's say real estate, is around, I think, $80 million. So that's $80 million out of the 600 already, just in like houses. And for those houses, what we know is that to kind of maintain those houses, that's a lot of money. So you need staff. And so basically staff, you need to get like, let's say, I don't know, a huge mansion, 10 or 7 bedroom. You'll need, 5 to 7 people that will be cleaning, doing gardening and all those stuff. You just get minimum wage, a little bit higher than minimum wage, multiply that by that amount, and easily to kind of take care of all those mentioned, you will be spending like half a million a year, easily. So that's
it could even be $1 million a year, just taking care, because things will break, and houses, you have to know what you're doing, especially when you're buying houses. So for me, a crazy expense for me will be like something a little bit cheaper. Like I wouldn't buy a 40 million house like he's doing. I think that's just too much space and too much work. I'll probably travel a lot, like see different countries, but I don't think that's gonna cost me 40 million. Right? Yeah, because like if out of 20% of that money will be like 100 million, I guess I can spend like another 10 million on houses and stuff like that. Just having a nice house, nice neighborhood, all that stuff. But apart from that, like the rest of the 90 million, I'll just find, someone who is good at, or some company, or build a team, right, with people I trust, and start my own private equity firm. And that would be my job, basically. But I know you know a little bit more about private equity than I do, so.
Yeah. So, I mean, going first back to your kind of crazy expenses, right? I just wanted to jump into, one of the, I would say, business ideas that I came across. It's not even, it's an idea, but someone is doing it currently. So regarding the expenses, the kind of expensive house, there is a guy that is investing now into mansions. So he will buy like old mansions and then renovate them and then use them on Airbnb. So we'll rent them on Airbnb, and the business seems to be very, very profitable. I read it in a book. I can't recall the name of the book now, but it's a business model. So if this guy is smart enough, he can kind of manage to at least cover his expenses by renting that house on Airbnb when he's not there. You rent it for parties, you get insurance underneath it, and you just make sure that you just get good money out of it. So that's just one point.
Yeah, I will just add this little caveat to it. Renting an $40 million house on Airbnb, I don't think that's a smart move. Like you will make money, but again, who are you targeting, right? If I'm gonna spend like $1 million on a trip, there is a very small percentage of the population that can do that. But if you have 40 million, you can go to states like, Florida, Arizona. And I've seen this, what you're talking about. I've seen other people doing this. And I'm in the Airbnb business myself. So I look out for those trends, right? And you can go to Austin, Austin, Texas, Arizona, some nice cities there in Florida. And what you can do, and what I've seen people do, is buy like maybe a $1-2 million dollar mansion, and they put everything in it. They will put like a tennis court, a basketball court, a sauna, a pool, all sort of games, so that when families travel, they don't even need to leave the house. It's like you are going to a personal resort kind of thing. And I think that is a much better business model than like buying like a $40 million house and trying to rent that out.
I see your point. The one that I was referring to is actually for like parties. But yeah, I mean, that's something I came across when I was reading a book, and someone seems to be doing it in a very successful way. But yeah, I mean, coming back to your second point, even before going to the second point, I think one kind of key learning point here for, I don't know, anyone that's listening is, when you are making, let's say, even a little bit of money, don't leave it on your bank account. Go look for, in your country, I don't know, whether you are in France, in the US, in the UK or whatever, go look for, bank accounts that give a higher interest rate comparing to your normal high street bank account. So typically, the large, the fancy name kind of bank account, banks, I would say like the Barclays. Here is like the Barclays, the Lloyds and all those things. They are not the one that give the best interest rate. They will just chop you off and give you something underneath inflation. So that's the key learning point here.
Yeah, and I actually made that mistake myself. So if you want to check that out, check out some of our old videos, and you'll probably see me talking, going in details into the mistakes that I did when I came to the US.
Yeah, even me, I did that myself. I left. My savings used to be in my I used Barclays. Used to be on my Barclays account for quite a while. But yeah, moving on to the private equity topic, which is something that I'm quite interested about, because I do a lot of work with private equities. And really what you said was that you kind of just build a private equity or hire a team to kind of help you toward that. So what I would say is a little bit more trickier than that, and a little bit more complicated than that. So the whole kind of private equity thing, I think the main thing to kind of build a private equity is to have a track record. And that's really, really difficult to have, because what the whole private equity thing is, I mean, a lot of people try to make it very complex, but it's very simple. It's basically, instead of putting your money into companies in the stock market or in stocks, you put money into companies that are not on the stock market. But there is a but. The but is that you have a control on what that company do. I mean, you can steer the ship in terms of like their strategy. You can guide them. So that's kind of the whole thing about private equity. So you need a track record, and that track record is like us when we are applying for jobs. They want to see what you've done before. So for those, they call them GPs or fund managers, the people that will be at the top of the private equity. Usually they will need to prove that they are able to, first, depending on the strategy that they are using, but the most common strategy is identify companies with potentials, and then setting up strategies to kind of leverage the potential of those companies and multiplying their, let's say, their EBITDA. EBITDA, I mean their bottom line, or let's say profit, to make it simple, and sell those companies at a higher priced at the bottom. So basically, to make it very, very simple, it's just like flipping houses. I mean, people that are in like the real estate, they will understand this.
Or flipping businesses, basically.
Exactly. You need to show that you can flip businesses or you can flip houses.
So when you say you need a track record, let's say for me, for example, I just want to understand. I just want to learn from you, actually, right? Let's say I have my $80 million, right? And I decide, okay, I'm going to take $400 million and put it in this firm, right? And I start the firm. I'm maybe like the CEO, but a hire, to me, I think me hiring someone is that person needs to have a track record. But for me, who is putting the initial amount of money in, I don't think I need anything, right?
Let me help you there. So the goal for most private equity, this is another tricky part, is don't put your money in it. So they will put like 5% of their money. That's the amount that they will put in. Very little. When people know that you put a lot of your money, some people, which is very strange, some people may think that so basically this whole thing is about raising money. That's the first step of every private equity. You need to raise money. And to raise money, you need to go to investors with your kind of idea, and then be like, okay, this is the strategy of this, fund. We will be investing in companies in the US that are in this sector, that have, this potential, and we will flip these companies and manage to make, 20%, rate of return on these companies when we sell them, right? So if you end up putting a lot of your money in, the people will think that you were unable to raise money. That's why you put a lot of your money in.
I see.
So I do know some private equities where they were about to raise like a fund, and they were unable to raise the fund that they want. So basically, let's say, I'm just going to be throwing big numbers here. Their goal is to raise, let's say $2 billion for their fund. And for this fund, they gave like a time limit. And then at the end, when it was like getting close to the end, they were able to raise, let's say, $1 billion. These people are normally very rich. So they ended up putting their own money to complete the fund. And in the kind of sector, that's seen as you were unable to raise the money, so your pitch or what you plan is not convincing. So that's the first thing. They don't put their money in.
I see. So it makes sense too. It makes sense because this whole, like, if you want to operate it like a real business, right? If you just have your money in it, I don't think you will be as efficient as you will normally be, because again, like, let's say I'm still going back to the lottery because this is the potential that we are going off of, right? You don't respect that money because it's your money. You didn't really work for it, right? So you are not going to take care of it but if you have other people's money in it, and let's say these people that you have as your co-investors they also have a good track record in the private equity market, then all of a sudden, your private equity itself will carry a bigger amount of respect, because they know that these people who are like, I don't know, billionaires or like very successful are also investing with you. That's already a good thing. And second thing, it's going to increase your effectiveness, because now you have access to this high net worth individual that have done similar things in the past that are also going to give you like some of their input to help you if they are not silent partners, I'll say. And you can have some of these people on the board, and they will also help you in taking like a very big decision. So yeah, I can understand why that is. And if you want the company to be successful in the long run, you will definitely need more people to be interested in what you're doing and invest along with you.
Yeah, so those investors. So I mean, let's say if you were to win that money, right? It's better to just invest in, I don't know, different private equity instead of you building your own private equity, because you don't have the track record, so that will be a little bit difficult. So investing in other private equities is the idea. But in terms of the investors that are kind of investing in the fund, I mean, let me just explain this thing a little bit so that people don't get confused. So, what private equity do basically? First, they will prepare like a quick strategy, a strategy to kind of raise fund, and then they will go out there, speak with people, pitch, and etc., and then raise their fund. So they raise their funds. There is another period called like a formation, like a lot of legal stuff that they will be doing to kind of form the fund. So after that, what they will do is to invest. So that's the investment period where they will go out and just acquire companies like savages. They will just buy, identify companies with low potential, depending on the strategy. Because some private equity strategy can be buying distressed companies. So companies that, there is a huge problem going on there. They will buy it and fix it and those things. And the strategy varies, but, after the investment, they will try to kind of flip those companies, not sell them directly, but they will try to improve the performance of those companies. And that can be done by, maybe restructuring the companies, maybe doing some bolt-on acquisition. So bolt-on acquisition meaning acquiring other companies that can add to the return of that company, of the initial company. And they will do a bunch of stuff to kind of raise the performance or the profit of that company. And at the end, there's going to be the exit. So the exit where they will be selling those companies. So they will be selling those companies to make their money. So they will sell those companies and then they will start paying back what they took from the investor. So it's a whole process, and typically it takes like 10 years for one fund. And that's mainly the reason why everybody can't invest in kind of private equity. So first, it takes a lot of money to do. I think the average is like 250K to put in. And then when you put in, you can't, be getting money at the end of the month or at the end of the year, because you have to wait for the private equity to kind of execute or implement their strategy and then flip those companies at the end, and then they will start paying back people. And paying back as well, that's a whole other thing. Right. I mean, if you want to recap it like very quickly, what they typically do is there are two ways. So they will have a management fee. So me as a private equity, I will manage your money, the money that you gave me to invest. And for that, I will charge you. They typically charge like 2%. And their funds are big. If you talk about like the kind of large private equities, let's say they can have like, 10 billion fund, for example. And if you take 2% out of that, that's a good money. So they get that per month. Right. And then on top of that, they will be like, okay, if we manage to make you more than 7% or more than 8% of what you invested. So if our internal rates on, the money that you invested is like more than 8%, anything that's on top of that, we will share it together. So that kind of 8%, they will call it like hurdle rate. So that's where, that's quite similar to like let's say the stock market, or if you were to invest in index, you will be getting like 7% or 5%, those typical amount. And that hurdle rate, if you cross them, you have to divide the money. You as an investor, divide what we make for you with us. And usually,
so that's probably going to be like 50% of the outperformance, right?
No,
even more.
They do 80-20. That's what they do.
Hard.
But the investor is 80 though. We are.
Oh, okay. Oh, okay. That makes sense. I'm like, it was there.
No. They do. And that's how, those fund managers get a lot of money. So they will have, let's say, they raise like a fund for like, we were saying 10 billion, for example. And then they will be getting their 2%. So their 2%, that's like 200, I believe, 200 million. And then on top of that, 2% that they will be getting every year. At the end of the, when I say every year, they will be getting a portion of it every year, or they will just wait and get the 2% at the end of the 10 years. And then at the end, on top of that, they will get the profit that is on top of the money that they invested initially. Basically, they make a lot of money. That's what I'm trying to say. I don't want to go into like a lot of calculation.
So what if the fund doesn't perform? They still get paid, but what happens to the investor?
My dear, that's so basically they have like a contract, right? I think the name of the contract is limited partnership agreement. So in that contract, they will, explain everything regarding the hurdle rate that I talked about, regarding, regarding their strategy, the fund that the companies they will be targeting and everything, and regarding the payment. And usually a lot of private equity will tell you if, you need to be ready to lose your money if you are invested in private equity. But this doesn't happen often because this goes back to what I mentioned first, which was the track record. So nobody want to mess up their track record, and they will go above, they will do everything not to mess up their track record. And so I was saying as well that it's like investing in a stock market, right? If you have a portfolio on a platform and then you select, let's say, 5 or 10 companies in which you invest, you can have 8 companies that will fail miserably in terms of their performance, and then only 2 will save you. It's the same for private equity. I know of some private equities where they will have a fund, they will buy, let's say, 15 companies or even 20 companies, and then 10 of them are going to be very bad, and then maybe 3 or 2 are going to make huge money when they flip it, and that will be the one. Yeah,
it's the same concept with venture capital. It's the same concept. I think and some angel startup investing funds as well do the same thing, where they will put I think the only difference here is that compared to private equity, venture capitalists don't have too much say in the company they invest in. They don't control the company. They don't make the decisions and stuff like that. They just invest. But private equity, basically from what I'm hearing from you, is that they will basically take control of the company. They will make some of the decisions that the company has to make and to make them profitable. But from what I've read and my experience with people who are in the venture capitalist world, they especially in Silicon Valley, where a lot of startups are receiving funds to build their technology companies. They give you the money, and that's it. A lot of startup or a lot of venture capitals, they will just put a lot of money in 100 startups, and they hope that 1 or 2 of them will go big and they will make all their money back.
In terms of the probability regarding 1 or 2 will go big and they will make their money back, I would say that's pretty similar, though with private equity the rate is higher because so if you talk about funds, venture capital, they use the same process. It's just about the stage. So venture capital is more about startup. That's the first thing, and the second thing is that it's more about equity kind of acquisition and stuff. While private equity, everything is based on, the most popular one, everything is based on debt, which goes for there is one term that they use, which is leverage buyout, where the private equity will, so that 10 billion that I was talking about, they are not going to take that 10 billion only and then just buy businesses. They will use a lot of debt to buy a huge stake in companies so that they have the control of the company. But in terms of control, they are not going to be there trying to kind of guide the company every single step of the way, because that's too much work, basically. So what they will do is they will hire people that they trust and put those people at those places. And what will happen then is that monthly, those people will be kind of sending financial performance to them, and they will be reviewing those and making sure that they are, on top of stuff and making sure that everything is, everything is going well. So I would say those are the differences, mainly the stage. So venture capital is a little bit earlier, and the rate of failing in venture capital and angel. So first is the angel. First angel, and then venture capital, and then private equity. Because for private equities, the companies, they are a little bit older. They've, I would say, proven themselves, on the market. But maybe they need a little bit of funds to grow really fast, or maybe they've, let's say, I'm just finding the right way to kind of explain this without using too many complex terms. So there is something they call the chasm for every company, or for adoption of a product. So you have the early or the first people that acquire a product, and then after that there is going to be the chasm, and then the product will go mainstream. So it's the same for companies. The company will start, their product will be acquired by like, newbies or people that are really into it. And that's where, the whole angel investment and the venture will be. And then after the chasm where the company is trying to go like further and be mainstream and be really big, that's where the private equity will come in, and they will take the company to like, mostly they will take it to like the IPO, so which is taking it to public and selling it, making the company public on the stock market and then leaving. So that's the long answer.
Yeah. There is a slight difference between private equity and venture capital, because private equity, like you said, they hire their own people that they trust to manage the company. Well, when you're comparing that to startups that are taking money from venture capital, the founders or the managing team is kind of there. Usually startups don't have like a really big management team, but the founders are kind of the managers. And as they are growing, maybe they hire more like experienced people. But this is again something that the founders control, because for venture capital, the idea is to have some equity in the company, not to actually control the company or how the company operates. So there is that difference.
Just to give you like an example, let's say Apple, for example. I think before the iPhone 3 came out, I think the iPhone 3 was the main one that the one that took them like kind of mainstream, right? In terms of
iPhone 3GS, I think.
Yeah, 3G. iPhone 3. So before the 3G, I would say the years before that, they could have gotten into like, they could have had, I don't know, angel investment, could have had a little bit of venture as well.
But Apple was already
they were in
public company at that time.
At that time, were they?
Yeah.
I don't remember. But basically, what I'm trying to say is that when the company is not mainstream, or the company is like very, very tiny, trying to grow, is like, I don't know, a startup beginning of their process, they will go, venture for equity, and then when the company wants to push for like a huge growth and etc., they will go for like a private equity that will come in with a lot of debt and kind of try to steer the ship, add few bolt-on acquisition to make the value of the company grow, take it to IPO or sell it to another private equity. Sorry.
Okay, so given the because you mentioned something there that I was kind of curious about. Private equity seems to be using a lot of debt.
Yeah,
and given the high interest rate environment that we are in currently, I was watching a video the other day where someone was saying a lot of private equities are going to go under because of the high interest rate environment, because they can't really borrow as much. Not all of their companies, but some of them are not doing well because of inflation, the whole geopolitic environment that we are in, and the high interest rate environment. So would you say that, without debt, private equity cannot really operate?
That's a really good one. As I said before, that is very dependent on the strategy. If it is a leverage buyout private equity, so most of the private equities, they use like a leverage buyout, which is like us, the way we get our mortgages. You will provide a little bit of a percentage of the worth of the company, and then you get, I don't know, 70% or 50% debt to cover the rest. So that's how most private equities proceed in terms of how they purchase, and they call that leverage buyout. So without debt, the ones that use those strategy, it will be literally impossible for them to kind of work. And in this kind of environment in which we are, with high inflation and very, especially in Europe, very complex macroeconomic kind of situation, in the sense that we have the war in Ukraine, a lot of we had like the gas and then electricity prices that just went up like crazily, and those stuff. It's really difficult for like everyone, but for private equity is I would say more difficult, in the sense that their companies like everyone else, are not performing like amazingly. And those, you remember I talked about like the fund process where at the end they need to exit. So when you exit, that's when they pay, they sell their companies, either they sell them or
That's when they actually make their money.
Exactly. So because of this environment, they can't do that now because of the inflation, and a lot of companies have been hit hard as well. So meaning the company's bottom line is not going to be looking as great. So if you want to sell your companies, they are not going to be worthing that much. So the company needs to be performing really well before you sell it, right? So that's one thing, they can do that. And the second thing is that the interest rates are quite high as well. So the other private equities that will borrow money to buy from them, they are not going to be able to do it neither. And IPO taking the company public and going to the stock market, that's another challenge as well. So what they are doing
that's
now
a challenge right now. We are able to see that with Instacart and Klaviyo and ARM, all those three companies. Actually, two of them are actually pretty good company, ARMS and Klaviyo, which is a marketing company. Yeah, those two companies are kind of good companies. ARM is not making a lot of money these days, but they are very good companies, stable companies. But the IPO wasn't what we saw in 2020, 2021, where you have companies like Wish.com, which is supposed to be a $4 stock, came on the market and became like a $100 stock and went back to $2.
That's crazy. Yeah, so yeah, that's the challenge. So most of them, they are waiting now. So they will wait. So depending on the fund that they have, some fund will have like a lot of liquidity. So by liquidity, I mean they will have like money that they haven't invested, and they will maybe use that money to do very little acquisitions that are not like too expensive, where they can increase the value of their current companies, or basically they are on standby. Everybody's on standby.
Everybody's on standby. And there is people say this a lot sometimes in the investing community. Basically, you want to have enough money to survive the hard times, right? Because some of these companies being in standby, what it basically means is that you are spending money and you are not making enough. Basically, some of their companies will be in the red. That's basically what it is for some time. So if you can, and this goes for startups as well, where if you can keep your head above water for the hard time, the hard environment, the high inflation, high interest rate environment, till interest rates start going down again, you'll make it out. But if you can't, so basically there is a clock ticking, and if you can't make it, then you'll die basically.
Yeah, that's a very good point that you mentioned, because for for the private equities to sell all these companies and to kind of exit them, one thing that they do in that process is a due diligence. So they will do like a legal due diligence, a financial due diligence, a commercial due diligence, which is where I work. So they will do all these due diligence. And after COVID, right, well, one of the key kind of trend in terms of due diligence, and one thing that all the private equities were trying to make sure of, is to prove that they're either the company that they want to buy or the company that they are selling. So if they are trying to buy, they will want to prove in the report that you are providing to them that this company is recession resilient, which is a kind of new term that came out at that time. So you need to prove that during recession, right, this company doesn't suffer, or the industry in which the company is doesn't suffer too much, that the company is like really resilient. And that's a way to sell as well. So to kind of exit or sell all these companies, right, one thing that's very important is like the storyline. So they want to come and be like, company. Yeah, exactly. They want to be like, okay, this is the company that we have. This company, the revenue is X, was X few years ago, and now, it grew at, this percentage. The EBITDA grew at this percentage. The performance of the company is very, very good in terms of like recession. This is like a bulletproof company that we are selling to you. The management team is great. They are well trained. We got people from, here and here. The experience is this, and etc. etc. So it's all about that storyline. So making sure that everything ticks there is very, very important.
Yeah, all the boxes are checked basically. Yeah, this recession-proof concept, it is an interesting concept because a lot of companies, especially in the startup world, in the tech world, cannot fit that metric.
Why?
Because the whole thing about startups is that they lose money for a very long time before they start making money. And most startups don't qualify for recession proof because the whole idea in the tech world is that you are going to be losing money for some time, especially in the venture capital world. But for some, probably something we'll discuss in the next podcast is solopreneurs. There is a very tight community of 9 to 5 people who have stopped 9 to 5 and have gone their own way and started like small businesses on the internet. And a lot of people in that in that world are finding a lot of success. They are even doing better than some of these startups and private equity firms. We have a lot of example of people making like $1 million a year or $1 million months even. But yeah, in general, tech companies don't fit that unless you're doing something that is service based and the service is required regardless of the economic or the microeconomic conditions. Being recession proof is very hard.
One thing I would say is that at the beginning stage, at the early stage of the company, that's not possible. And that's where it goes back to, the things I was talking about regarding the difference between venture and private equity, where the private equity will come when the company is not mature, but when the company has crossed that chasm. So for the tech companies, the one that you are referring to, I'm sure are like the ones that, are really like startups. They haven't made it yet. But once you kind of cross that bar or that level, I think for tech companies, actually, it should be easier for them to be recession-proof when they are mature, right? Because let's say, the last recession that we've had, so we had the financial crisis and then we had the COVID. So if we pick, let's say, one random tech company that is kind of mature, I think during those times, they will be performing, depending on the sub-industry or sector, they will be okay.
Yeah, like you said, it's sector dependent, right? And I don't know which company to use, but something like I mentioned before is like Wish.com, for example. They are like a company, it's just like Amazon.com, but basically you order stuff from China. And I've used the service before, and the shipping time is awful. Like you buy something, it's going to take you like a month before you get it, right? For stuff like that, and when you have competition, right, and someone is doing better, like you are competing basically against Amazon. You are getting the product at a cheaper price, but the shipping cost is high, and the wait time to get the product is also high. So, while Amazon, when you have Prime, you literally wait a day or two and you get your product. You're going to pay a little bit more, but the convenience is just better. Like companies like that, for example, they are not recession proof. If you look at their stock today, is not really good. The stock has really, really underperformed.
That's the problem with IPOs, right? And that's the problem with the stock market as well. And that's why really my background is in finance, and my kind of major or sub kind of subject is like stock market. But sometimes I just really don't like the stock market because of the behavioral part of it, in the sense that it's mainly based on how people feel about a certain product. Basically, it's the hype, right? If the hype is great, the price of the stock is going to go very, 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 very high. And then if it is bad, it's just going to drop again. And people that are really, really good at estimating the real worth of a company, so basically a good, really, really, really good valuation, are the ones that really can leverage this stock market, like the Warren Buffett of this world, and etc. etc. So I'd rather just stick with my index, man.
Yeah, that's a good point. Yeah, stock market mostly is very emotion driven for a lot of people. and this is why most fund managers can't even beat the S&P 500. Most of them can't. So if you can beat all of them by just putting your money in there. Yeah.
Well, that's fine. That's fine. That was a good chat. So, I mean, before we bore people with, just investment kind of talk, let's dive into a little bit of kind of technology and what's happening in the meta world, the world of Mark Zuckerberg. I mean,
yeah. I think this is a good segue actually when we were talking about startups, because today with AI, ChatGPT, and everything else, there are hundreds of AI startups that are coming on the market every day. Every day you go on Twitter, someone is building this AI startup. And 2021, in the low interest rates environment, it was crypto. Everybody was building a crypto startup. Now, AI is the new crypto, basically. So we had two major announcements last week about AI. One of them, which I think I like the most, is the AI voice translation that is being built at Spotify. And us being in the podcast business, kind of, this is very interesting to us because, one, we are both French speakers and English speakers. And I'm going to play that video for you.
When you say the word toxicity, how are you defining that? You're saying like toxic chemicals que introducimos en nuestras vidas, en nuestra piel, consumimos, inhalamos, tenemos a nuestro alrededor y que están en nuestros alimentos, etc.
How do you think? O sea, a modo de consejo, ya que lo estamos platicando, a diario, ¿qué opinas sobre los problemas difíciles del mundo?
Yeah, so basically, people who are making video podcasts today, the idea is that people who are making video podcasts in a certain language, these video podcasts can be translated by AI, and is your mouth will move and your voice, everything will be kept the same, but the only thing that will change is the language in which you are having your conversation. So let's say you have a podcast of 2 or 3 people, everything will be seamlessly translated into a new language. So podcasts that are being done in English can now be in French, Spanish, and basically you can grow your business, your podcast business, and your audience in other countries without having to really do any kind of effort. Well, I don't know if Spotify is gonna sell this to podcasters, make them pay some fee to do the translation, because well, it depends, right? Because at the end of the day, Spotify is the one winning, but we are also in a weird technological environment. I don't know if you heard about this, but all of these things are dependent on GPUs, and we have some kind of scarcity of GPUs today. Basically, a lot of companies.
What do you mean by GPUs?
Yeah, GPUs is a graphical processing unit, right? Companies like NVIDIA, Microsoft, AMD are the one, even Intel, they produce all these GPUs. GPUs are basically, they are just like computer processors, but they allow you to process image, videos, and stuff like that. And that's why you are able to see me on your screen and stuff like that, right? So in the video game world, NVIDIA was number 1 in this. But the CEO of NVIDIA, because they had issues with their business at some point, was feeling like it was like they were going to be stuck in the video games world. And he basically managed to repurpose the use of graphical processing units, GPUs. And he basically found a niche in the AI world where, because of their parallelism, basically graphical processing units can process a lot of tasks at the same time. And this is something that is highly needed when you are using AI. So because he had these products, and that was the problem with AI, he was able to advertise his company to carve a big niche for himself. And basically all the ChatGPT, everything you are seeing today with AI all the Mid Journey for generating images and all that stuff, they are all running on NVIDIA GPUs and some other sort of GPUs. And that's why you've seen NVIDIA stock kind of quadruple over the last, the last 8 months. Yeah, the stock have basically quadrupled. So that's what is happening. So there is a scarcity. Even I heard the UK was going to spend £100 million to reserve some GPUs from NVIDIA. And this is what is going on. Because, a lot of countries know that this AI revolution is going to change a lot of stuff. So nobody wants to be left behind. But if you are going to do AI, you need some processing power. And NVIDIA is the only one supplying that right now. So it's costly. It's costly. Even I am working on AI at my company, and we know the challenges that comes with that, but I'm not gonna get too much into that. So it's gonna cost Spotify some money, but it's gonna generate them some money as well, and maybe they can charge for it for people who want to grow their audience in at different countries, or they can make it free. And the whole Spotify thing is that they are selling ads when people are watching podcasts on their platform. So I don't know, but it's very interesting. I think it's gonna change a lot of things, even for people who are doing videos on YouTube, right? They are going to be able to reach more audience in different countries using this technology. And there are other smaller startups working on this as well. It's not just Spotify. So this is something to look out for.
I think it's as you said, it's very interesting, and for people that want to have like side hustles on YouTube and stuff like that. This is massive, right? This just kind of quadruples or triples your addressable market in terms of the people that you can reach. Just increases your reach amazingly. So I think it's gonna be a very, very big thing. And you just imagine in your head being able to produce a video in one language, and then everybody else can watch it in the world. That's amazing. And that goes also back to the whole globalization thing that the politicians kind of launched, I'll say maybe 20, 30 years ago. That's a really big one. Regarding the second topic, though, for me, I think I was more interested about the second one, to be honest.
Let me just give a little bit of information to the public here. Last week, there was another announcement from Facebook, i.e. Meta today. Their CEO, Mark Zuckerberg, was on a podcast with a big podcaster, Lex Friedman. And they basically recorded this podcast in the metaverse. Basically, they were wearing their headsets, their the Quest headset, and they did this podcast. And inside the metaverse, there was a 3D rendering of these two people. So their head were rendered and in a 3D fashion. And it's very the imaging is pretty good compared to the first version. So we will put some image on the screen for the audience. But
headset. You were right here.
I don't know if people can see this, but this is incredible. The realism here is just incredible. Where am I? Where are you, Mark?
This was it was pretty good, but I am not just buying this whole meta thing, right? Apple is also bringing a product on the market for this, and Facebook bought this company Quest a long time ago, and they are trying to make it a mainstream thing, a mainstream product. But I don't know, man. I'm a UI engineer, right? I build interfaces for all sort of devices. And I've always had issues with a device kind of blocking your sense somehow, or making you uncomfortable, and putting something in your face, even if it has a camera and you can still see. Man, I don't know. I don't know if it's the best user interface to me. And that has always been my problem. It's not the technology itself, but having something on your face at all time is just something that is very difficult for people to get on board with. And that's why I think Facebook, even though they have been spending like billions of dollars trying to make this thing a reality, is not catching on. But yeah, tell me what you think.
I think you made a really good point there. Really, I think you did. To be honest with this kind of VR thing, I learned about it. I think I got like more into it in 2019. So that's 4 years ago. And I work on a due diligence where the private equity was trying to acquire a company in the UK. And that company sells VR headset, and really they manufacture them. I don't want to give too much detail here, but they manufacture them in Asia. I'm not going to give any name. They manufacture them in Asia, and then they bring them in the UK and in the US as well. And they really try to sell them to primary and secondary school. And this VR has short courses and stuff that you can kind of upload onto them, and it gives you a very kind of immersive experience. Let's say in biology, for example, a student can see like the bones and touch stuff, not touch it, but get kind of close to it and those type of things. And after the work was done, one of the key things that was like very, very important for the private equity guys, and I still remember this question that they asked us. It was about the penetration. So the future penetration or the market penetration of the product, right? So at the time, we kind of estimated the market, whatever, and how the product will grow. And at that time, the penetration of the product was very, very low. It was like around the 1% or something. And the guys were very, very concerned about that. And basically, they were thinking, will this product pick up in the future? So if we buy this company and we invest our money in it, will this company, will the product pick up later, and will we be able to kind of flip it and make our money? And this is the question I guess we are asking ourselves now in terms of like, VR, is it going to pick up one day or not? But my answer to that is, I would say no. And it goes back to what you were saying. I think I'm more into AR than VR.
Right. Yeah.
So VR is very uncomfortable in the sense that at the beginning, I remember that there's like the PlayStation VR as well, and the first reviews that came about those were people were becoming a little bit dizzy after they used them. There was, I believe, the Oculus, the one that I believe Facebook acquired as well.
Right, Oculus,
and so it makes you very uncomfortable. Though that has decreased now, it's not the same. Some people can feel very, very dizzy and all those stuff. So I think that's going to be the main reason. And I don't see people, wearing headsets and then walking around the street. That's not possible. And
even like currently, the amount of processing that this thing needs. When I saw the Apple demo of their headset, I think it's like on battery, it only works for like 1 or 2 hours. And that's Apple. The latest M2 Mac, that's what I'm using. Battery lasts a day of full work. I can work on battery for a full day, 8 hours without any problem. So most of these headsets, you have to plug them in. You can't really move. You start to sweat around your eyes and stuff like that. I don't know, man. It's pretty uncomfortable to me, but we'll see. I don't know if Apple is going to pull this one off, but so far, all their venture into the AI space, like the Apple, they had like the Apple speaker as well with Siri, and they were trying to copy Amazon Alexa, and now they are trying to copy the headsets, the VR headsets from Facebook. I don't know. I would like to see it when it comes out, but I don't know. I think people are over it.
Yeah, I mean, my short answer will be is the AR. AR is the future, the artificial intelligence, where you'll have maybe a part of a glass on your face or something like that.
Yeah, talking about that, even this week, Facebook came out with another version of that. It's not completely AR, but these are like Ray-Ban glasses with cameras. So Facebook is partnering with Ray-Ban to develop these glasses, which will basically scan everything in the world. Facebook has some very good AI technologies, which allow to identify almost anything in the world. It's very good compared to other things. And basically you can ask questions and stuff like it's just like Google Glass. I don't know if you remember Google
I
Glass,
remember that, yeah.
which didn't work.
Yeah, it
So
didn't work.
I don't know. Facebook is giving it another try. Let's see how that
Let's
goes.
see how that goes. Let's see how that goes. But yeah, I mean, it's been very, very, very interesting to kind of talk about all these things. I think we'll wrap it for today. But it's been been great to kind of share this insight with people. I mean, if you have any kind of comment or thoughts about the subject that we talk about, please drop them in the comment. And thank you very much. More guesses are coming. More guesses are coming, and more very interesting conversation and tips are coming as well. So yeah, that's it.
Thank you, everyone.
Me and my buddy, we making all of this money. Yeah, I know it's rude to be bragging. They never catching us slacking. Me and my buddy, we working hard for this money.